So hello and welcome. My name is Sarah Luttrell. I'm the Communications and Events Manager at the Center for International Development. I'm really excited today for our discussion on bringing credibility and transparency to impact investing. The format for today's event will be a 20 to 25 minute presentation with around 15 to 20 minutes for question and answer. During the question and answer session, we just ask that you add your questions directly to the chat or use the raise your hand function so you can ask your questions directly to the speaker. We're also recording today's event, and this session will be available on CID's YouTube channel after the event. The next speaker series that we have is on Friday, November 13th. So just a reminder that we won't have events on October 30th or November 6th. So the next on Friday, November 13th is with CID Director Asim Khwaja on a smart containment approach for COVID-19. We also have an event next Wednesday that we're co-hosting with the Harvard Kennedy School's Institute of Politics. So that event is on Wednesday, October 28th, as I've said, from 12 to 1 p.m. Eastern time. So the same timing of this event. It's on global health and leadership, and it will be featuring Peter Sands, who is the Executive Director of the Global Fund. The event will be moderated by surgeon, writer, and public health leader Atul Gawande. So we're very excited for all of the upcoming events, and we hope you'll join us. I'll also add links to connect to all of those events and our newsletter and social media in the chat of today's event. But without further ado, I'd love for us to be able to dive right into our presentation for today. I know we're all excited. So I'd like to introduce today's moderator, Shawn Cole. Shawn is a professor in the finance unit at the Harvard Business School, where he teaches and conducts research on financial services, social enterprise, and impact investing. We're also fortunate to have Shawn as a faculty affiliate with CID. So thank you for being here today, Shawn, and Neil, also to you for being here for your presentation today. So over to you, Shawn.
It's a real pleasure to be here and see you all here today. I'm thrilled to introduce Neil Gregory, who has the title Chief Thought Leadership Officer at the International Financial Corporation, the IFC, which is the private sector arm of the World Bank. As most of you know, the IFC has kind of invented impact investing, starting back in around 1963, I believe, with their first equity investment, and they have been getting good returns. I have a recent research paper with some colleagues that show that they've outperformed public markets by quite a healthy margin over the past 40 years. But Neil is going to talk today about some of the work that the IFC is doing to promote credibility and standardization and impact in impact investing, as well as to take more general questions. He is an economist by training, having graduated from Cambridge and Oxford, but also has an MBA from Georgetown, and we're absolutely thrilled to have him here. About 20 minutes, and then we'll shift over to Q&A if that works for you, Neil.
Great, thank you, Shawn. Thanks for the introduction, and let me also mention I have a couple of colleagues joining who are Harvard alum, and so glad to have them part of this. And so Diane Damsky, who manages the Secretariat for the Impact Principles that we'll talk about, and Elizabeth Lewis, who's our communications lead for impact investing. So I'll invite them to also contribute to answering your questions when the time comes. So first, let me take you through a brief presentation about some of the work that we're doing to try and bring credibility, discipline, and transparency to the impact investing markets. First, a couple of slides just of background, just to make sure we're all on the same starting point in terms of, firstly, what is IFC? If we go to the next slide, many of you will already know this, but maybe you think of us as a development institution, but we're also, we are that, but we're also the original impact investor in many ways. When long before the term impact was invented, the IFC was the first of the multilateral institutions which was set up with a mandate to finance private investment and not to take any government guarantees or to do anything with the public sector, but to invest debt and later equity in private firms with a mandate for economic development. And so IFC's mandate from our establishment over 60 years ago was always to have impact as well as to be financially sustainable. Although we're owned by the member governments of the world, we receive no subsidies, no government guarantees, so we have to stand on our own 2 feet commercially. If our investments don't make money, I don't get paid, just like any private financial institution. So that's what makes us comparable to other impact investors, a little bit different from the World Bank and other development institutions. So today we do all kinds of investments, both long-term debt, equity, and guarantees. We provide advice to client companies, and we also increasingly focus on mobilizing third-party capital through various platforms. And it's partly through that mobilization work that we realized that there was a greater need to bring some discipline and transparency to the impact investing market, because increasingly our co-investors were interested in investing with us, not just for the financial returns that they could get in emerging markets, but also because of the impact that they could have by investing with us. If we go to the next slide, this will be familiar to any of you who have studied the subject, but for those who haven't been following closely, there are different definitions of impact investing out there. So we won't spend time to debate it in this session. I'm just going to put out there the definition that we use so you know what I'm talking about for the rest of the session. So for us, there are 3 key distinguishing marks of an impact investment that makes it different from ESG investing or other forms of sustainable or responsible investing. The first is that the investor has a positive intent to invest for impact. It's not just a byproduct of a financial strategy, that impact is part of the strategy. Second, that the investor actually contributes to the impact created by the investee company. So it's something more than just holding shares in impactful companies. You have to have some theory of change of how your actions as an investor contribute to the achievement of that impact, either through the financing you're providing or through other forms of engagement with the client company. And thirdly, you have to measure and report on that impact, just as you wouldn't call yourself a financial investor if you didn't measure your financial returns. So you can't really call yourself an impact investor if you don't measure and report on that. So that's all by way of background. And the next slide, really just want to explain why we think that, if you click again, please, there you go, why we think that impact investing has become such interest to so many people in the last few years. Just go back to the previous slide. I'm doing this remotely, so apologies for the jumping back and forth. So what we've seen since 2015, when the Sustainable Development Goals and climate change goals were agreed by the international community, is that you've seen increased demand from asset owners of different types in the market for assets which contribute to those goals, that go beyond just ESG risk management and have some positive contribution. Particularly in Europe, you see pressure from pension policy holders and other retail investors who want their savings to have a positive contribution to impact. You see increasingly the various pools of capital realizing that it's not enough for them just to invest their capital for financial returns. They also need to think about what kind of a world that they're creating through their investments. And so the financial services industry is really just responding to that client demand. And so it's rapidly moved beyond the traditional investors for impact, the foundations, the development finance institutions, and now you're seeing it go mainstream. You have the biggest asset managers in the world offering impact strategies to their clients to meet that client demand. So we have taken a stab at estimating the total size of the market. You may have seen on the next slide, you may have seen the gin market estimates that get published each year. Those are kind of based on self-reporting, and we thought they didn't capture all the markets. So we've taken a different approach of trying to actually gather publicly available data by different types of asset class to build up a picture of the impact investing market. And what makes this rather a complicated picture, and why I can't just give you one dot, but you've got several of them here, is that it's very difficult, based on publicly available information, to know which investors actually meet all 3 of the criterion of having intent, contribution, and measurement. And so we find that there's a lot of investors who have some of those attributes, but not necessarily all of them. And so there's a smaller core, which we identify as being about $500 billion, which we think really has all of those attributes in an observable way. and about $200 billion of that is the DFIs, like IFC, and bilateral DFIs like the US DFC and CDC in the UK, and so on, and about $300 billion of private equity funds, which clearly have systems set up, which both have an impact strategy as their intent and a measurement process. But beyond that, there's other parts of the market where we don't really know enough to say whether they meet all these criteria for impact investing or not. But it's important, I think, to be aware of them, because potentially they could be a much larger part of the market. So there are other funds which claim to have impact in their mandates, but they don't clearly measure and report on it. So the total private market could be as much as $400 billion. There are a lot of national and regional development banks which have some kind of development or social or economic mandate. The biggest one of those being China Development Bank. There's Development Bank of South Africa, BNDES in China, in Brazil, banks like that. They manage $1.5 trillion of assets, and we don't know enough about how they manage them and how important impact is in their decision making, but potentially that's another big block of assets which has some kind of intent for impact beyond just financial returns. And then you have public market funds which claim an impact intent and often report on the impacts of the companies in their portfolio. What we don't know enough about them is what is their theory of change and how in public markets you actually contribute to the impact of their investee funds. So that could be another $1.5 trillion there. So adding it all together, the potential size of the market we think could be as much as 2 trillion. But the core of that, where we're really confident that they're doing all the things that make you an impact investor, is much smaller at $0.5 trillion. And that delta between those two numbers of 1.5 trillion shows the need for this greater transparency and discipline. There's still a lot of fuzziness in the market about how a lot of these pools of capitals are managed for impact, and that's what we're trying to address. So I think we can skip the next slide. So let's go on 2 slides. Because what I want to talk about next is what's stopping the market growing and reaching maturity. And there are a few things which we have identified in our work. And so all of these are areas which we're trying to help push forward the knowledge agenda on. The first one is that for most investors, they want to know that they can make a financial return as well as having impact. Yes, they're interested in impact, but fundamentally they're still investors. And so there's a big knowledge gap in understanding what actually is the financial track record of impact strategies. Can they achieve comparable financial returns or not? And we'll come back in a moment to a slide showing the work that Shawn was talking about in his introduction. Secondly, when we talk to asset owners, and we do a lot of this around the world, talking to pension funds and insurance companies and sovereign wealth funds about what would it take for you to make some allocations or increase your allocations to impact. A lot of what we heard from them over the last few years was that they were interested in doing that, but that they were confused by different labels in the market. They saw funds being pitched to them labeled sustainable or SDG or impact or climate, but they didn't really know what was behind that label and how those funds would be managed for impact. And we'll come back to the solution we have to that challenge. Thirdly, in many jurisdictions, there are restrictions facing institutional investors. They have fiduciary duty requirements which are interpreted in different ways. In some jurisdictions, they feel comfortable with taking impact into account. In other jurisdictions, including, I think, mostly in the US, that's really been a factor which has been a deterrent to institutional investors in considering impact in their investment decisions. And so I think there's need for evolution of the understanding of what fiduciary duty means. And finally, it's still a bit of a mess in terms of the way which people actually measure and report on impact. There are different indicator sets, different standards. And so for asset owners wanting to build a portfolio of impact assets, it's very hard for them to compare across funds and across investments on a consistent basis. And they'll talk in a minute about what we're working on that agenda. So if we go to the next slide, I talked a couple of minutes ago about what we think the size of the market is today. On this slide, I'm showing some data from a report we did a couple of years ago, where we set out to try and do some back of the envelope estimates of how big investor appetite might be if we address those structural challenges that I talked about on the previous slide. And I'll share the link with the report at the end if you're interested in digging into the methodology. But let me just give you the takeaways now. If you click again, please, Sarah. Thank you. So the two main insights here are firstly that there's much larger appetite for impact investments if you can demonstrate that they can offer comparable returns to other investments there, not surprising. And secondly, you can see there's a much bigger appetite for assets in public markets. Now today, as we showed in the earlier slides, most of the assets that you can credibly label impact are in the public markets, either private equity, private markets, either private equity or private debt. But so there's a gap there between what investors want to invest in. A lot of them want the liquidity and scale of public markets and the products that the impact investing industry is offering today, which is mostly in private markets. So if we want to scale up the market, we need to both be able to offer impact assets which can credibly offer comparable financial returns, and we have to close this gap. We either have to get more asset owners comfortable about investing in private markets, or find strategies for having a credible contribution to impact in public markets, or some combination of the two. So next slide, please. So on the first point about how do we demonstrate commercial impact, this is the research which Shawn worked on with co-authors from IFC and the World Bank, where for the first time we opened up the entire data set on IFC's equity investment portfolio since 1961 to look at what was the financial performance of it. And you can see that the overall result here was that we outperformed public market benchmarks, whether you look at emerging market benchmarks or the S&P 500. Now, it's clearly not entirely apples to apples comparison, but we think this is still an important signal for investors that you can pursue an impact strategy without necessarily giving up return. And I think an important takeaway from this is that we achieve these returns over a long period of time. We tend to hold our investments for longer than private investors, an average holding period of 8 years. And this ability to be a patient investor allows us to ride out the increased volatility that traditionally you've seen in emerging markets. If you took shorter time period slices of our equity performance, you would find a different picture in some periods. So part of the key to being able to outperform as an impact investor is being able to be a patient investor and have a long time horizon. Something else which this analysis shows is that we were overweight in lower income countries and more diversified than the private FDI flows. And I think a second takeaway from this research is that if you want to outperform while investing in emerging markets, going to the frontier, going to the markets which haven't yet matured, even though they look higher risk when you invest, is actually key to outperformance. That's been IFC's strategy over many years, is to try and get into markets ahead of private investors, and then we exit when others are ready to come in. And this suggests that that has been an outperforming strategy. If you have more technical questions on that, I'll refer them to Shawn. Moving on to the next slide. The second challenge that we've been trying to address is this need for clarity and discipline around what the label means impact. What does it actually mean if you say you're managing a fund for impact? So what we did with a number of both private investors and DFIs who've been in this game for a while was we got together and said, what are the core things that we all do in our management practices to introduce the impact dimension alongside the financial dimension at all stages of the investment cycle. If we go to the next slide, you see what we came up with is a set of principles which take you through the investment cycle of what you should do in setting your investment strategy, when you originate and structure investments, during portfolio management, all the way through to exit in the case of equity investments. And these sort of formed a common core of activities that disciplined impact investors undertake. And so by codifying those principles, we set a benchmark for what new entrants in the market need to do if they want to call themselves impact investors, and also provides assurance to investors that if they invest in a fund which is following these principles, the impact will be considered alongside financial returns at all stages of the investment process. And if you click again, please. The ninth principle is how we provide this assurance to investors. The commitments you make when you sign as an investor, as a fund manager or development finance institution, to say that you will follow these principles for a particular fund or strategy, there's two things. Firstly, that you will publicly disclose how you implement these principles in your own impact management system. And secondly, that you will arrange for periodic independent verification. This is basically a process audit which comes in and checks that your investment teams are actually doing these things on a systematic basis. And so this is what provides both transparency and credibility to what was previously at risk of just being impact washing. On the next slide, you see the smiling faces of the first group of signatories. There's now far too many to fit into one photograph. We now have 105 signatories as of today, and there are more in the pipeline. They manage at least $340 billion in assets. That's just based on those who have reported so far. We know the real number is going to go higher. And you can see it's a mix of both private asset managers and public development finance institutions. So far, 75 of them have published their first disclosure statements, so they're all available online. You can go and read as many of them as you like, so it's complete transparency. And 37 of them have already completed their first independent verifications. And what's been nice about this group is that even though we didn't set out to create another GIN or another convening organization for impact investors, this really is a practitioner group of people who are deep into the weeds of managing assets for impact. And so it has actually developed into a very nice community of practice, and there's regular seminars and workshops and the exchange of knowledge. Going to the next slide. This just shows the geographic diversification. We think of impact investing as having started in North America and Europe, but you can see now that there's good geographic distribution in the signatories. And I think the next slide is probably my last one. Yes, so what are we going to do going forward? The signatories are showing interest now that they've committed to these principles, which is what you need to do to manage a portfolio for impact. They're interested in learning more about the good practices and how to do that. So there's a lot of ongoing discussion on seeing how we can harmonize on a common set of impact measurement indicators. You can see some convergence around the ESG standards that signatories use. And I think there's interest in further alignment to a number of implementation areas. This probably doesn't mean changing the standards themselves, but it means that over time, this peer learning and peer pressure, I think, will drive more of the signatories towards more alignment in how they implement the principles. What we don't have yet in the verification is verification of the actual results. The verification today is of the investment process. So I think that is still a frontier that's ahead of us. We have that done for our own impact results that we publish in IOC's annual report, so we know it can be done, and I think that's a future direction that we hope to see the market go into. If we go to my final slide, this is just to tell you where, if you want to dig into all of those numbers that I threw at you rather quickly and understand where they come from and understand in more depth the analysis of the market that we've done, there are a couple of reports here that we've published that you can refer to. And then there's the website for the impact principles themselves, which gives you a lot more information. And you can see there the full list of all the signatories. If you want to find out if your favorite asset manager or fund is following the principles, you can find it there. And then you can go and read their disclosure statements and see exactly how they're managing their money for impact. So I think that's as much as I want to say for now. I'm going to open up and let Shawn moderate the discussion.
Excellent. Thanks so much. Practitioners are so much better than academics at sticking to the allotted time and allowing for some discussion. So that's great. I want to start off, Neil, by asking, sort of setting aside the verification question, this came up from the audience chat. How does the IFC itself measure impact? And are you satisfied with that? Or do you think that you've got a lot of work to do on that dimension?
Mm-hmm. So IFC convenes a group of DFIs who developed a common catalog of impact metrics called HIPSO, which stands for Harmonized Indicators for Private Sector Operations. And HIPSO was also the basis for the development of IRIS Plus, which is the leading impact metric set used by private impact investors that's managed by the GIN. And over the last year, we've actually been working to make sure there's full alignment between those two indicator sets, and we're pretty much there. So I think we do have a core set between IRIS Plus and HIPSO. More than half of the signatories use those two indicator sets. So I think we do have the core catalog of metrics for whatever dimension of impact you want to measure, whether it's climate or gender or jobs. We do now have common approaches how to measure and report on that. I think the next frontier of this work now is that, as many of you may have been following, there's a lot of movement now to try and get corporates to adopt common standards for impact reporting. This work being particularly associated with the International Business Council and the World Economic Forum and the Big Four accounting firms. And the long-term vision should be that if corporates report on the right impact metrics, they give the investors the impact metrics that they need when they're investing in those companies without them needing to be a separate bespoke set of investor metrics. So we're now exploring how we can take the investor perspective metrics that we've developed and we use and see how that can converge with the ongoing work with SASB and GRI and others to develop corporate impact metrics so that in the end they should all be aligned. We don't want to be burdening our investee companies with additional reporting metrics. If we can agree on a common core of metrics, that's where we want to go.
I think we should just let everybody unmute themselves. Please raise your hand if you have a question. We'll let you jump in. If we get a Zoom bomber, we'll have to go back to a more restrictive regime. But I think we had a bouncer at the door already, so hopefully there won't be any Zoom bombs. Charles has a question about what the appropriate benchmark for returns is. Charles de Segundo.
Yeah, hi, thanks. Hi, Shawn and Neil. Thanks very much for a useful talk. The question was essentially around the sort of 8-year holding period that you were talking about, and then the work that Shawn and your colleagues did, sort of showing some outperformance. Mm-hmm. Sort of my sense is, which I guess it's just a question, is some of those investments may be illiquid. There may be other premia that you're harvesting that a regular S&P 500 public markets investor wouldn't be harvesting, and so maybe it's not an apples to apples. That's my question.
Yeah, you're right. It's not entirely apples to apples. I mean, clearly IFC has some advantages over other investors. We may be treated better. We have some advantages like that. This was not taking account of our operating expenses. This is also pre-tax. But maybe Shawn, you're a better place to explain a bit more.
I think all those caveats apply and are mentioned in the paper. I think one challenge is that there is no high quality benchmark that goes back that far in the private market setting. And if you will, you might say the IFC helped pioneer this asset class. And so what could they have done in 1963? Maybe public markets, but so I don't think it's crazy to make this comparison. And this is how academics tend to evaluate private equity as well. But it is net of fees to the extent that the IFC has invested in funds. And I think if an interesting future direction is to try to unpack the other funds' performances relative to IFC's own direct investments. But this is, my takeaway is similar to Neil's, that these are really good numbers, but they're not sort of the final definitive word. But it compared to much. Sorry, I'm an academic. I'll be quiet. I'm happy to talk later about the limitations and strengths of the studies. Let's go over to Rohit, who wants to hear about asset classes.
Hi, Neil. My question, and this maybe just to preface, I worked at a development finance institution for 5 years. So one of the criticisms I guess I had when we assessed impact was that a dollar of, say, US dollar hard currency lending is treated the same way a local currency loan is given, as the same way a fully secured trade finance loan is given to a company. And so I guess my question was, is the IFC evolved its thinking on how you assess and define impact based on asset class, and does that affect your investment strategy going forward on how you're planning to deploy funds?
So we invest across different asset classes, mainly private equity, private debt. We also do short-term trade finance, but otherwise we're mainly a long-term investor. So all of our investments, we run through an impact assessment process. We have a proprietary impact model called AIM, which basically scores every investment in 2 dimensions. What do we expect to be the project level impacts? Or what do we expect to be systemic or market level impacts? And so the type of impact and the scale of impact is going to vary by different types of products, different investments. And some will have a big market impact and not much project impact. Some will be the other way around. But because we run them all through the system and screen them all for impact, and our investment directors are accountable for achieving an average impact score across their portfolio, overall we look at all of our investments as contributing to that overall impact.
Can I ask you about verification, Neil? So we see a lot of misbehavior in accounting, and there are real penalties. You can go to jail if you fudge your financial statements. Without those penalties on the impact side, have you seen examples of people paying for verification and being told, nope, that wasn't really impact? How much credibility should we put into the verification market?
Mm-hmm. That's a great question, and the model that we're following, and honestly, it's a hypothesis which we're now putting to the test, is that if you maximize transparency, then there will be pressure from investors to ensure that the signatories meet some quality threshold. So what I mean by that is that you can take the verification process very seriously or not at all. There's nothing to stop you hiring your brother-in-law for doing it for $50 and really just treat it as a tick box exercise and not take it seriously. But you would then have to disclose that in your disclosure statement. Who was your verifier? When did they do it? What were the findings? And so it's that transparency that is making the signatories take it seriously. And maybe Diane might like to jump in on this point, as she works directly with all the signatories. But what we've seen is that they've taken this process very seriously. The bigger signatories have engaged Big Four accounting firms. Mid-sized one have used specialist firms like Stewart Vedqueen and Sustainalytics and Tideline and people like that who have a reputation in the industry. So it's really the credibility comes from the fact that this is all out in the open. And if you're an asset manager, you care about the name of the verifier and whether that will be credible with your clients, and you have to disclose the findings of the verification. But Dan, if you're online, do you want to jump in on this?
I could only hear half of it, so I don't know if it's my connection. Sorry.
Or your dog.
Sorry. But was it about?
What makes verification credible was Shawn's question.
Your question was, because I didn't hear the entire question, so if you could just say it again.
And the question was, what makes the verification process credible? What are the consequences if you don't take verification seriously?
Well, I think what makes it credible is that this was what every signatory agreed was important and critical to avoid impact washing or reduce the risk of impact washing. And the verifiers have to be qualified persons. It doesn't have to be an auditing firm. It can be auditing firms, consulting firms, but also some of the smaller signatories for which this is resource been very creative.
Dan, maybe turn off your video. We're having a
Committees
bandwidth
of their
problem.
LPs, they know the fund.
Diane?
So you can't, it can't be a agreement.
Yeah, I think
Diane, try turning the video off. I think we're having
can
a
we
bandwidth
mute
problem.
Diane? Can we mute Diane? I'll just take the chair's prerogative to keep moving.
Yeah, go ahead.
Because Neil did give a good answer. I'm sorry, Diane, that we're having technical problems. So the next question is from Massimo Santini, who is right now at the World Bank, and Massimiliano is interested in to what extent the IFC is helping governments coordinate impact and ESG dimensions, and to move this beyond an international cooperative framework and perhaps codify this in any way.
That's an interesting question. We have mostly taken the view that industry-led initiatives are more likely to gain traction. It's very much an open debate, as is often the case in financial markets, about what is the right balance between industry self-regulation and governments coming in and regulating. And I think the OECD is looking at the need for more government regulation. Our view is at this stage of market development, the industry participants know what they need, and they are motivated to provide this sort of credibility and transparency, because that's how they will attract capital from these large pools of capital we talked about that are interested in impact, if the industry can shape up and give them what they need. So we've really been focused on working with the industry really on the sort of self-regulation approach, and haven't engaged so much on the government side.
Great. Carrie Rue, who's a current Kennedy School student.
Hi, Neil. Thanks so much for taking the time to speak with us. I had a question about how you balance trying to create a broad framework that can apply to many different types of investors, but also the need for specificity when thinking about different impact outcomes can be so different to measure, and also thinking about how different industries and products can have sort of very different theories of change with regard to impact.
That was a key question as we were thinking about how to develop the principles, and we were aware that there are very small specialist impact funds, some may be managing $100 million or $200 million, and then you've got big asset managers coming in wanting to launch billion-dollar funds. So we're also thinking about how do you do something that's scalable. And so the way we really approached this was to say, well, you can be aiming for different types of impact, you can have different theories of change, but you should have a common approach to how you pursue that through your investment process. So, for example, we don't say in the principles that you have to have a particular theory of change, because that might be different in different asset classes, but we say that you have to establish as part of the investment process what your contribution to impact is, which means you have to actually think through and articulate the theory of change investment by investment. And then in your disclosure statement, you have to explain to investors what your theory of changes for the type of investments you're making. And likewise, for different types of impacts, we don't specify what you should measure for those impacts, but we say you should use commonly accepted metrics to measure those impacts and report on them, and again, disclose in the disclosure statement how you do it. So we're really trying to find this balance between saying what is the common core of processes that really are what integrate impact into the investment discipline, while giving this latitude for signatories to apply the principles as makes sense for different scale of funds, different geographies, different types of impacts, different asset classes.
Great. And now over to Kareem Sarhan.
Yeah, thank you very much, Neil, for this. My question is, do you adjust your criteria for what is deemed impact investment depending on the stage of development of the country? In other words, do you treat investments in low-income countries the same you treat investments in middle-income countries, or you might have different goals depending on the country?
Sure, so I can speak to how IFC does it in our own impact assessment approach. And here, as I say, we have a sort of a scoring approach where we ex ante, we try and establish what we think is the expected impact of our investments on 2 dimensions. What would the project level impacts be and what would the market level impacts be? And so the project level impacts, we try to go beyond just raw numbers, which I think is a weakness of many impact investing strategies. We don't just say, well, we've employed 50 women. We say, put that in context of the development gap. How much female unemployment is there in the place where this business is? And I think that's a big gap that you see in the market today, which we're trying to encourage others to move towards, is this kind of benchmarking and actually measuring impact relative to the size of the development gap or challenge. And so that's one way you would score the same investment very differently depending on the country it was in or the particular socioeconomic context. And then secondly, because and I think there's only a few of the big development banks do this because we're big enough to even plausibly think we can have an impact on the whole markets. We're more likely to have that kind of market level impact in small, low income countries where the market is smaller and we're relatively bigger investors. So projects tend to get higher impact scores in our system in small frontier markets, whereas if you go to Turkey or Mexico or some of the big middle income countries we invest in, it would have to be something really significant to be able to change that you were having a market impact there. Whereas conversely, if you make an investment in Sierra Leone, almost any investment you make there is going to have some kind of market impact because it's such a thin market. So that's how we kind of put things into context.
The last question is one I get often from Kennedy School students, which is, I'm passionate about impact. I think this is really intriguing. I might be able to repay my loans with a career that's industry, but I don't have much investing experience. Is this, you think, a growth industry that's going credible opportunity for employment for a Kennedy School graduate, or do you think they need to get some basic blocking and tackling and investment before they try to move into impact investment?
So I think what I can say about that is that as you see more of the mainstream asset managers and banks moving into this space, they're all having to build up their capacity to actually measure and manage the impact side. So most of them are developing teams that will do the impact assessment, that will do the impact monitoring, the impact reporting. So for those, you don't really sort of need core financial skills. You don't need to do financial modeling and so on. But having a background in development and general quantitative skills is going to be much more important. As we were just talking about, it's very important to understand the socioeconomic context of investments if you want to do impact assessment sensibly. So I do see lots of growth in employment of people working with investment teams, but have a specialist function, and so don't necessarily need core corporate skills. But I'll also say from my own experience, I first trained as an economist, and I went back to business school. I did a mid-career executive MBA, partly because I think anytime you're working in an investment institution, it always helps to be able to talk the language of the MBAs. So maybe you pick that up at Harvard between the Kennedy School and the business school, but some people do that by taking a CFA qualification along the way. But I always think that having some ability to talk the language and understand the way that finance people think about investing is helpful, whatever your role is in the team.
All right, please join me in thanking Neil for giving us his lunch hour. And I think Sarah would like me to remind you that next week is same time, same channel, Asam Kwaja. So thank you all very much. Appreciate the opportunity to speak with you all.